Okay, it's 9 o'clock and we'd like to welcome everyone to our webinar. And we'd like to make a couple of announcements on our insurance and risk management webinar. We're grateful to have our panelists and everyone involved and happy to have everyone here. And hope you all enjoy a great opportunity to learn some really helpful information. And we are going to get started with a few announcements. We'd first like to give thanks. We'd first like to thank our diamond sponsors for this year, Advanced Community Services and FCS Community Management. By way of announcement, our next webinar will be on October 20th, and it will be COVID-19 Association Liability and Practical Cleaning Tips. We'd also like to give a big thank you to our event sponsors. We have Sunwest Bank. And if you're looking for a bank that genuinely understands the HOA and property management industry inside and out, look no further than Sunwest Bank. With over 40 years in the HOA lending space, we have products and services specifically designed to meet your community association's needs, including a variety of time and money-saving options. Our Utah-based HOA banking team can work with you to not only pick cash management solutions that cover your complicated transaction and payment needs, but we can also help you secure financing for things like property renovations and short-term cash flow needs. Visit sunwestbank.com/HOA to learn more or call Chad Cantor at 801-699-1835. Another one of our great exhibit sponsors is SentryWest Insurance. And for over 30 years, SentryWest has specialized in providing insurance products specific to the needs of community associations and their managers. As an independent agent, SentryWest works with and represents a deep bench of providers who also specialize in insurance products for community associations. Several of these partnerships are exclusive to SentryWest or have a short list of brokers they appoint to represent them. SentryWest and its agents express a deep appreciation for the confidence and support community associations and their managers have given us. Thank you. And last but not least, we also have the McGowan companies, who are an amalgam of 5 companies with 17 divisions serving the insurance industry nationwide. McGowan Program Administrators is comprised of program administrators specialized in specific industry segments. The original MPA division was the Community Association Insurance Division. Joel Meskin is the managing director of this division. The mandate of this is to be the leading expert in the community association industry and to develop and deliver the state-of-the-art products and solutions for the industry. Also, they have McGowan Risk Specialist, which is a division specializing in certain products. Austin James is the associate director of the CAT and Special Property Division. TMC is an expert in collaborating between and amongst divisions. The program today is a perfect example of where the CAT and specialty property expertise is a key solution for many community associations around the country, along with the products of the Community Association Insurance Division that include D&O, crime, cyber liability, data breach, and umbrella. Both MPA and MRS work directly through your retail brokers. Just ask your agents to seek solutions and coverage through TMC. And with that, and another great big thank you to all our sponsors. We will turn the time over to our moderator, DeVoe, who will announce our program and how this webinar will operate. Thanks.
Morning, everybody. Welcome to our insurance and risk management during the brave new world of the COVID pandemic. We have several good topics. I think they're going to be at the forefront of everybody's mind in Utah, from earthquake insurance, fire insurance, wind events, and COVID, its effect on amenities, and what we can do to prepare for the next potential infectious disease pandemic. We have today with us LaMond Woods, who has over 25 years of experience as an insurance provider and risk management specialist. He's a senior partner at SentryWest Services and has served as a member of the CAI Legislative Action Committee for 10 years. Joel Meskin is Managing Director of Community Association Products at McGowan Program Administrators. He has his CIRMS designation as well as a Management Liability Insurance Specialist designation. He's the founding member of the Foundation for Community Association Research Think Tank. He has his CCAL. He's practiced law for 15 years prior to 19 years focusing on the community association industry. So truly a powerhouse and a wealth of knowledge in this field. I'm so happy to have him. And last but not least, as Mindy had mentioned, we have Austin James, who is the Associate Director of the CAT, which stands for Catastrophe, I learned this morning, and Specialty Property Division of the McGowan Companies. He's got over 10 years of experience in the negotiation of complex and high-risk property insurance placement, and I think he's going to add a lot of value given the experiences we've all shared throughout Utah this year in 2020. With that, if you have any questions, please feel free to type them into the question box. I will try to get them in there and get them answered during the appropriate segment or at the end, whatever is best fitting. So with no further ado, take it away, gentlemen.
Hey, Joel, I don't think your mic's on.
Yeah.
Yeah.
Oh, now I'm unmuted.
Yeah.
A lot of people like when I'm muted. So over the past, 6 months since the pandemic started, I've had a lot of time to, discuss this. This is my oldest grandson, Zachary, and I've had a lot of discussions about insurance and, what is all this insurance stuff about? And, his last comment to me was, why doesn't the insurance company just cover everything? Then he said, it just makes me so sad that they don't. It's amazing to me because that's basically the same thing that virtually all the insureds that I deal with, the boards and everything say as well. They just makes them so sad that this is happening. Okay. Oops. As Lauren said, as a result of the pandemic and for Utah, you guys have had a number of special events, and not the nice special events that have occurred over the past year or so that I think really open up the door for what you'll hear from Austin. And as she indicated, we're going to be discussing earthquake insurance in the marketplace and what you need to really keep an open mind for and listen closely if you don't listen to anything else this morning is the parameter insurance discussion that Austin is going to be introducing to everyone, because that really, I think once you start to learn about that, may provide you with solutions that unfortunately very few know about. Then we're going to deal with a few, with the fire insurance issues and really the kind of things that you need to focus. Also, we understand that you had a little bit of a wind event this past year, and now people are really trying to figure out, what kind of wind coverage they need. Are carriers in the market going to maybe reduce wind? Are they going to require that you have a separate wind policy? So that's something that we're going to discuss. And then we're going to get into the opening of common elements in community associations. I've received, I would say, 800 to 1,000 phone calls over the past 6 months. Basically, people saying, "Can we open our pools?" It's only second to the question of, is there a God? People just really have this passion and need to open their pools, and I understand it, especially when they're home, and especially when their kids are home, because pools are good babysitters for parents. And then I'm going to give you a little bit of a hint on what we can do to avoid the next communicable and infectious disease pandemic. And we'll go from there. And so I'd like to turn this over to LaMond and let him jump into the next topic. I'm trying to, my
Well, our next
I
topic
have a
is
delay.
going to be
Oh, there it is.
perfect about earthquake insurance. Earthquake insurance over the last 20 years has certainly been, in my perception, the most volatile of any line of coverage that community associations are purchasing or have to have. Why so? And it's simply due to the impact that a large earthquake event could pose, the financial impact it could pose, not only on the insured, but on the insurance company. So as we have more catastrophic events that are occurring around the world, reinsurers are the ones who are really driving, the price of earthquake, the availability of earthquake limit. They have to watch, they meaning the insurance companies, what their total exposure might be. I had one carrier a number of years ago who said that if they had had a major earthquake event, and again, this goes back probably 10 years, but if there had been a major earthquake event, it would have bankrupted the company. If that earthquake would have happened just in Utah and in Washington State, where they had a big book of earthquake insurance. So the way insurance companies handle that is they buy reinsurance. And I'm hoping Austin will talk directly to the reinsurance market and those sort of things today. But yeah, if we go a while without an earthquake, association, their managers, and primarily the board of directors are looking at ways to save money. And earthquake insurance has always been expensive. So up until this year, early this year, there was starting to be a trend of dropping earthquake insurance. Again, because of the cost increases, the coverage decreases. Boards are saying, is it really worth it? And deductibles are high. Remember that a deductible on an earthquake policy is always a percent of the reconstruction value of typically the building that's affected. So $1 million building, replacement cost of $1 million that has a 10% deductible, that's $100,000 of damage that has to occur before the insurance will start to kick in. 10% is not uncommon. It is possible to get as low as 2% deductibles. There's 5% deductibles, but some carriers are going to 15 and even 20% deductibles. So again, when the earthquake hit earlier this year, that 5.7, we started getting a lot of calls. But as you might guess, underwriting started for a time there was a moratorium placed on earthquake insurance, with most carriers saying, hold on, we're not going to write insurance, any earthquake insurance for a few weeks. And that worked itself out within 30 days, and carriers started opening up again. But we saw a limited availability, and we saw higher rates happen. So with that, I'd love Austin to share with us his perspective on earthquakes.
Sure. Thanks, LaMond. So as many of you probably know, one of the most economically destructive earthquakes in recent history was the 1994 Northridge Event. At the time, actually, that was the costliest disaster in our nation's history. That caused $20 billion worth of damage and $49 billion of economic loss. So that was a magnitude 6.7. Last July, there was a 7.1 in Ridgecrest, California, which luckily was directed mostly to the north of Los Angeles, so it didn't cause a whole lot of damage. And then, of course, what LaMond was speaking about, y'all are very aware that you had a 5.7 around Salt Lake City in March of 2020. So the point is that earthquakes do happen, and when they do happen, they're incredibly destructive. So what's going on right now with the insurance marketplace, much to what LaMond was speaking about, they're starting to take a look at what's called their aggregate exposure. So basically, insurance companies are taking a lot harder look of their exposure in one specific area, because if an earthquake was to hit that area, they could potentially become, hopefully not insolvent, but they could take a very large loss. So they're starting to take a much harder look at their aggregate exposure. And also management is taking a harder look at their rate of return on their capital. So the capital that they're putting out, they're wanting a higher rate of return. They're also taking a look at their limits, condensing their limits down to smaller micro-sized limits. Instead of maybe 30 million bucks, a carrier might start putting out 5 or 10 million in smaller chunks so that they can manage that exposure that way. So basically all this ties in with total capacity that's in the current marketplace right now. So insurance companies in general are they're wanting more money for their capacity. There's a combination of factors involved in this. Pretty much nowadays, everything is dictated by modeling results. So insurance carriers use, there's multiple software systems that run the past 50 years of earthquake activity and try to use that data to predict future events, future magnitudes, and whatnot. And so a lot of companies now are tied to this model. So they they have to satisfy their management in terms of following this model, where in years in the past it was less, they were able to deviate a little bit more from that model. But with the market tightening a little bit, the underwriters are kind of stuck to that model. They can't just throw a number out there anymore. So the prices are definitely going up, and this started back in I would say August of 2019. We started to see an increase in the Western earthquake placements. I would say right now a 10 to a 15% increase is a good result with a building with good characteristics. And the good characteristics could be newer buildings, further distance from fault lines, and that sort of thing. Building with worse characteristics, older, newer to the fault lines, susceptible to more earthquake damage. We've seen as high as 30 to 45% increases. Like LaMond was saying, gone are the days of a lower earthquake deductible in earthquake regions. Now it's a percentage. The lowest I've seen is a 2% in Utah, and the norm is on the way up. So you're starting to see a 2, a 3%, and even a 5%. Obviously, to save money, you can go to a 10 or even higher. But now across the board, the standard's starting to become a 5%. So what can you do? As far as with traditional earthquake, you could just work with your broker and looking at various options. You could look at different deductible options, 2, 3, 5, 10% if you want the coverage. And you could also take a look at reducing your coverage. So if your total building reconstruction cost is 25 million for all of your buildings, you could take a look at more of a condensed, what's called a primary, and look at a 5 or a 10 million to save a little bit of money. But interestingly enough, there is a new product out there for the average buyer, which is very interesting and has a lot of application, especially for earthquake insurance, and that's Parametric. So Parametric Insurance is not new. It's new to what I would call the middle market space, so the average consumer, the average condominium or homeowners association. It's been around for about 25 years, and it started in the reinsurance space. So it started with what's called insurance-linked securities. Basically, they were bonds using derivatives to act as reinsurance vehicles that the financial market created. And today, that insurance-linked securities market provides about $100 billion worth of capacity to the reinsurance market. So this kind of coverage translated into index-based derivatives, which what they do is they base themselves off of natural disasters. So you could have earthquake, hurricane, wildfire, flooding, drought, that sort of thing. So the history of parametric started in reinsurance, but it has moved into the primary insurance sector and the middle market sector. So what is parametric insurance? How does it work? So parametric insurance is also called index-based insurance. What it does is it uses a predefined, it's called a trigger, and it uses a verifiable data source, a third-party data source. Once that trigger has been met, the limit that you purchase can be available for indemnification or paying for making you whole, rebuilding your buildings, that sort of thing. An interesting thing about parametric payment is that it's rapid and there's no adjustment period. So the trigger in the policy has to be something finite and measurable. So for instance, with earthquake, typically the trigger is not magnitude. A lot of insurance carriers will use maybe peak ground acceleration or some form of the intensity of the earth shaking, because that's a better measure of economic damage. They'll use a sustained wind speed for hurricane, or you can use hailstone size for hail. And then you also have a third-party participant, which is measuring these triggers and the data. This third-party participant has no knowledge of you having an insurance policy or a transaction based on the data they're putting out. They're not involved in insurance. They're simply weather data analytics firms. So for instance, earthquake could be the USGS, hurricane is RMS or a variety of modeling systems, which are third-party, and hail, we use CoreLogic, but there's other weather derivative services you can use. And so that's kind of the overall parametric generalities explanation. But as far as earthquake goes, so in the case of earthquake, the trigger could be the intensity of the earthquake, and then the data source would be the USGS. So that's the United States Geological Survey, a government entity that is measuring earthquakes all the time. That's where you see your news reports from. So there's different intensity measurements, but generally they use some form of the actual intensity of the ground shaking, and it's reported by USGS. So how's it priced? It works a lot differently than your traditional earthquake insurance. So it can be used as a buy down, reducing your deductible, or it can be purchased standalone. But typically you don't buy your full replacement cost of your buildings because it would be prohibitively expensive. It's more of a blanket limit across your property that you can buy, as there is no deductible. For instance, $1 million limit will cost anywhere roughly from $30,000 to $60,000, depending on where you're located and the trigger points. Interesting thing is age and construction is really not a consideration in your pricing. Currently, the way the earthquake market is going, there's not the 2% deductible is the lowest, and it's still pretty high. It's a pretty large retention that the board has to assume. So this is an interesting vehicle that the boards could use to reduce that exposure. So what are the advantages of the parametric over a traditional earthquake policy? So there's a rapid payout, there's no adjustment process, and there's relatively no exclusions. So essentially the way the policy works is in a traditional earthquake insurance policy, the event occurs, the insured inspects the property, submits a claim to the insurance carrier sends out an adjuster, the adjuster performs their duties figuring out what's going on with the property, and then they adjust the claim, settle to a certain amount. There might be some argument there, and so it takes some time to figure out what's really going on, what needs to be replaced, where the parametric policy is completely different. When the event occurs with the certain measurement being hit in your location in terms of the peak intensity, your limit would become available. There's different ways of payment. Some of the policies, it works like a pure derivative. So you would just receive your cash, your limit, and then you would adjust in 12 months. Other policies, you would submit a signed statement of losses. Here are the losses I've had. It can include pretty much any economic losses generally. So it could be, it's not necessarily things that are covered under the traditional property insurance. It could be that, but it could also be other items. It could be cosmetic damage or damage to outdoor property, something that's not covered under your traditional earthquake policy. So you would take that, send it over to the carrier. The carrier would verify the event occurred, and they would send you your money within 7 to 10 days. So it's a lot quicker payout, and it reduces the time that the cash gets in your hands in order to start the rebuilding process. So it's really, really cool. It has a lot of applications, limited exclusions. It's a very, very neat product. Actually, the state of Utah purchased this product and received a payment from their carrier during the March earthquake. So they purchased the policy from Swiss Re since 2017, and they did receive a payout for their economic loss in the Salt Lake City earthquake. But now the interesting thing is that it could be used for even smaller properties, so you don't have to be in the state of Utah to buy it. So that is Parametric.
All right. I just wanted to add in a couple comments. In the community association world, as most of you have learned by now, we're a little different and special from other middle market type businesses, and we're different than our individual insurance, our homeowners association policy and such. And the determination of whether we get insurance such as earthquake is really up to the board. And one of the challenges, I was practicing law in California during the Northridge earthquake, and I won't share how well I came out of that because I helped so many people. There were so many opportunities, but in a community association in California, I would say the majority of associations had no associations, were left without being able to rebuild their associations, or in some cases, they just had to put up more money to fix it. But what you have to keep in mind is part of the fiduciary obligation is the board is there to protect the assets of the association. And to protect those assets, we have both insurance that you purchase, and we also have risk management and reserve studies, which we do. But the reserve studies, are for wear and tear and not for unexpected perils like an earthquake. And so what you need to be able to do is buy insurance so we minimize any surprises that the association may have. Yes, earthquake is really expensive in some places, not less expensive in other places, but the goal of boards, and I know nobody in Utah has ever seen this, is to avoid surprises and not to make the unit owners happy. No matter what you do, you're not going to get a consensus of happiness among your unit owners anyway. But what you need to do is you have to do what is necessary in the best interest of the association. And sometimes, in California now, when people move into an association, most of the associations do have earthquake. And one of the reasons they do have earthquake is a lot of them had significant problems when they didn't have earthquakes previously. And that's a really hard lesson to learn and a hard way to learn that lesson. So at minimum, I think earthquake really has to be seriously considered. And now that you may have parametric earthquake, you can bring in an expert, a LaMond, and then maybe Austin to do, a conference call with them to help them under their specific situation, whether it be a good deal or not. And I think in that situation, you'll be covered. And as you may or may not be aware, some policies will provide the board with defense of the duty to obtain or maintain insurance. but nobody will provide the insurance that you didn't purchase. And then there are a lot of package policies, and I'm sure LaMond, during the break, whenever your next meeting is and you have a break, can tell you that there are some carriers that don't have this coverage. So you have to keep that in mind. So LaMond, I'll let you go on to the next, beginning the next issue.
Okay, our next issue is concerning fire insurance. So basically property insurance coverage. The next slide that'll pop up are properties, buildings that have had fire damage. At least one of these is a client of mine, and probably managers or at least attorneys would recognize some of these. Well, about a year ago, there was a substantial fire in a property in Provo. It was a bit older of a property. The fire sprinkler system was in just a couple areas of the building. It was determined that the developer didn't want to pay the freight, so to speak, for that fire suppression system to be put in the entire building. It wasn't in the attic, which is where this fire started. The last I heard is that damage was going to exceed, the cost for the total claim was going to exceed $6.5 million. Of that, and we'll get into this a bit more, there was a substantial amount of the claim that is going to go to what's called ordinance or law. We'll talk about that. But in terms of just the marketplace, we are seeing companies, I'll pick on Travelers, they've really taken a knee-jerk reaction to non-renewing virtually any account that has much of a wildfire exposure. In Park City alone, we had a lot of communities that are now looking for insurance or will be looking for insurance. But frankly, they've been doing it all year because Travelers made that decision the first of this year, even before this fire season that we are hopefully at the tail end of. And again, the reason for companies like Travelers getting off those risks is simply they have these huge exposures that they want to stay in business for tomorrow. And again, I think in some cases they are getting off accounts that they don't have a large justification to do so, but they're looking at these darn modeling systems that it's not an actual person looking at a Google Earth photo or a map or sending someone out there to look at it. They're just taking a very broad brush and saying, okay, we're non-renewing all of these accounts. Fortunately, other companies are stepping up. It's not as though everyone is having difficulty. At least that discussion of wildfire is on virtually every market and on every underwriter's mind. What is the likelihood of the exposure? So that's impacting our costs. Even though in Utah we've had a limited amount of damage, structural damage because of wildfires, we're seeing a push and pressure on rate because the carriers who are paying those billion-dollar losses in, say, California, are having their own costs go down. So they're passing off to us the costs for reinsurance, and it isn't as though we have exposure for wildfire, but I do believe it's less, certainly less than the Oregons and Northern California areas of the world. I'll turn it to back to you, Joel, but I want to touch base on the ordinance and law. That property that I mentioned in Provo did not have a fire sprinkler system. It's a multi-story building, And to get a building code or building permit, they're going to need to put in a fire sprinkler system throughout the building. That is going to be a very costly event for them. And it'll really push the limit of the amount of ordinance and law coverage that you have. So is ordinance and law coverage a concern for every community? Some of those communities that are brand new, that are just a few years old, do not have the exposure to ordinance and law coverage like an older building would have. So think of, are your buildings, would they have a problem with ADA if there was a major loss? Would they have to improve access and those sort of things? Insurance isn't intending to build something or give you more than you had before the loss. Their job is to pay for what is there at the time of loss. And so when you're having to put in a tens of thousands of dollars for a system like a fire suppression system that didn't exist in the building before, you're having to get a limit outside of just the traditional coverage, and that's the ordinance and law coverage. So again, on new construction, not a big deal. When your properties start to age and as laws change, where the construction code is they're more concerned about maybe it's earthquake, how the building will hold up in an earthquake, or maybe it's just life safety. They want to know that people are going to get out of a building and have time in the event of a fire and not be trapped. Joel.
Yeah, actually, I just wanted to ask, before we go from fire to wind, I'd like to ask Austin one question. As a catastrophic property expert, I mean, you get to deal with all these pain and suffering issues of insureds. In the fire area, when do they come to you? Is it because they can't get insurance from somebody else, or are you able to provide them with any specific products or anything? Does the Parametric have anything or any ability to work with respect to fire?
Sure, good question. So when someone comes to me mainly for fire insurance, if it's not involved with hurricanes or earthquakes or extreme hail, for instance, in the state of Utah, it would be someone that has had probably a large fire in the past. It could be some older wood frame construction that doesn't have sprinkler protection. It could be an association fire, meaning fire property insurance. Could be someone that's had significant water damage losses. So basically, anything that comes to me is it's a result of it being unattractive to the admitted type carriers that want your better in class risks. So also, we're starting to see, like LaMond had mentioned, the wildfire risk. So carriers are now modeling wildfire, so they're taking a look and determining certain zones that are brush zones. And admitted carriers, like LaMond said, it's not so bad in Utah right now, but as far as California and other areas, certain areas, I mean, prices are going through the roof because admitted carriers are pulling out, saying it's a high fire risk area, and we're having to come in with our carriers, which unfortunately price things a lot higher because they're higher risk. And you might go from 1 carriers to 6 in order to provide the limit you need. We're also seeing incorporation of wildfire deductibles, so separate deductibles for wildfire. I don't know particularly if you're at that point in Utah right now, but definitely the brush score zone is the determination of whether or not it's going to go to excess and surplus or admitted.
So when question from the audience for Austin as well.
Go ahead.
So with these high deductibles, whether it's for earthquake or wildfire, if an association was either forced to or chose to get a high deductible policy, could they then obtain the parametric insurance to cover that high deductible?
So as far as earthquake, yes. So earthquake would provide a it could be work like a deductible buy down. So the parametric could be purchased in lieu of earthquake as just a blanket limit, or it can be purchased with earthquake as well to provide coverage underneath your deductible. And it also pays out regardless of whether your insurance carrier is going to pay out. And it can also provide coverage that's might be excluded under your other carrier. So it's pretty much like a blanket limit that provides coverage underneath your deductible as well as wraps around it and things that aren't covered. As far as wildfire, I'm not aware. There is a parametric product, but it's not for mass scale use. It's mainly for agricultural, so it doesn't really apply. But I'm not aware if there's a deductible buy down for wildfire. I have not seen any. Even the carriers that do the fire buy downs are afraid of wildfire. So there might be one out there, but I have not seen one yet. I think if this trend continues, I'm sure that will develop, and there will be a carrier that will, be available.
Okay, can we, Austin, because we have a couple things that we have to get through, so can you just jump right into wind and what you might be able to add with respect to wind, and then I will get into the wonderful world of COVID-19.
Sure. So as far as wind goes, windstorm encompasses straight line, wind gusts, tornado, and obviously hurricane. We'll leave out hurricane since you guys fortunately don't have that exposure in Utah. But in general, hail is getting worse. It's getting bigger, and the research is showing that the severity is increasing, not necessarily the frequency, but the severity of the events is frequency. And also the belt, which traditionally was in the Midwest, is widening. So we're starting to see hail in more areas than just the Midwest. Obviously, windstorm can cause pretty significant damage to roofs, mainly in the Midwest and in the West. So what's happening as a result of wind is carriers are increasing their deductibles in a lot of areas. So instead of having a wind deductible that is concurrent with your fire deductible, you're starting to see application of higher wind deductibles, whether it's a higher numerical number or it could be a percentage, a 1 or a 2%. And most carriers now are applying a cosmetic damage exclusion. So if there's a windstorm that hits straight line or hail or whatever it is, they don't want to pay for cosmetic damage. There are different structures in regards to windstorm. So deductibles, you could have a percentage per building, you could have a percentage per location, or you could have a percentage of your TIV. So be pretty careful when you're looking at your deductible and make sure you understand it. The most common is when you do go to a percentage is a percentage per building. So if 1 or 2 buildings out of 20 were affected, the deductible would be the percentage per building. Now also to note, there is the application now. A lot of carriers are putting on there what's called a minimum per occurrence. So the most common structure is a per building wind deductible, but there's also a minimum per occurrence, meaning that a common structure, let's say, will be a 2% wind hail per building and a 50,000 or 100,000 minimum per occurrence. So what that minimum per occurrence is saying is that that's your basically your lowest deductible. So if you had only one building that was affected during a windstorm and the percentage deductible, let's say, equated to 25,000, but your minimum per occurrence was 50,000, the 50,000 deductible would actually apply. So just, when you're reviewing your quotes and if you're seeing any windstorm deductibles come in, make sure that you're reviewing that and also understand the minimum per occurrence and how that affects your reserves. There are separate policies now for wind deductibles that are higher. So there is a separate policy. If you do get a percentage deductible and you want to bring it down to a reasonable level, there's a separate policy you can purchase which can bring it down to basically your fire deductible. And that's called a wind deductible buy down. That works with your carrier, so when you submit a claim, to your carrier. They negotiate with the wind buy down carrier, and if your property carrier accepts the loss, then the buy down will come in and obviously pay underneath their deductible, and you would only be responsible to the deductible that you've bought down to.
All right, I'm going to jump in because our time is somewhat running down. As I indicated when we began, there's good news and bad news about the COVID and the impact on community associations. From an insurance professional standpoint, with all the pain and suffering people are going through, the one good thing is people are being educated about insurance far more than they have in the past. People are learning things that they had no reason to think about. It sort of goes back to that, why isn't everything just covered? Then we have the issues, as I'm going to address right this second, is we moved into the community association because of the common amenities. And we've been 6 months and we can't use our common amenities. Why can't we use them? We clean it, we follow the governor or the Department of Health instructions and such. Well, there are a couple of things. And the first thing that I want to mention in this area, one of my mantras, and I've insured over 200,000 community associations now and dealt with more directors and officers than anybody really deserves to be able to work with. And the key thing is, when you're a board for a community association, you have certain obligations of assets to protect. And what you don't have is the requirement to protect liability that you're not told that you need to protect. For example, a swimming pool. During the summer, maybe you have a few college kids come back and you want them to teach swimming lessons in the pool, and you don't think to call LaMond, you don't think to call Lauren and say, hey, do we have any additional exposure here? Is our insurance going to cover that? So that could be assumption of something that you don't need to assume, and there could give rise to somebody drowning under the care of the individual. And you know that no matter what the individual provides to the association as additional insured or certificate of insurance, they're going to go after the association. So with respect to the COVID-19, okay, people are coming in a couple of different areas. The first area is, if we open the pool, do we have any liability? Yeah, you have significant liability, and the liability is, that if somebody gets sick, there is a causation issue. There's a causation issue. Let me put back the slide, because it may be hard to prove that, but on the other hand, what you don't want to do is be in a situation because you're not going to be able to have coverage. So you're going to be what we call self-insured. You're not going to have directors and officers liability coverage. And the reason that you're not going to be able to have directors and officers liability coverage is, in the directors and officers policy, we have what's called an absolute exclusion. Most of the claims against the association are going to be arising primarily out of the potential for COVID-19 to happen. There are arguments that, well, they haven't become sick yet, so why do we care about the property damage? We're just trying to compel them to either close or open the pool. The problem is, and when you read the bodily injury exclusion, it is so broad. It basically states if the claim, which involves closing or opening because of the COVID, directly or indirectly is based upon, arising from, in consequence of, or in any manner related to any bodily injury, sickness, disease, or death of any person, I think it's going to be hard to argue that it isn't related and arising from the disease. And the one thing that you can be certain of. And I know Austin's been talking about damages in the billions. We're talking about damages in the trillions arising, potential damages arising from the COVID-19. And what that results in is carriers are going to fight this tooth and nail. And if you're going to challenge a carrier, and a lot of attorneys will take your case to challenge the carriers because they'd like to get paid to go after insurance companies. They'll always, not always, most of the time they'll tell you that there's a possibility to win, and they don't share that maybe 2% possibility that you'll win, and it's going to cost you a lot to get there. But at the end of the day, you're just not going to be covered under the D&O policy. So we're not going to have coverage under the general liability. Under the general liability, there are a couple areas. Number one, virtually all the policies out there have a communicable disease exclusion. And you may have a couple, I don't know if Greater New York is out here in Utah, or Philadelphia is writing a lot in Utah, because they were very silly because neither of them had a communicable disease exclusion. And not only that, Philadelphia removed the intended and expected exclusion. And those are the two key things that, even though no carrier out there ever intended there to be coverage arising from a pandemic, this is a completely new area to all of us. We're all treading and, having to chart new waters. And so, with respect to a couple of insurance companies, you may have a little bit more of a ability to do this. On the other hand, every case that's come out in the United States so far, and I've seen about 6 or 7, they basically have completely rejected coverage for the COVID-19. And the big area where most of the claims are coming are, let me go to the next one. Oops. Okay, business interruption coverage. And I think there first are arguments that an association, which is a not-for-profit company, doesn't have business interruption, because even though technically the fees and dues are revenue, the people who are really being impacted are the unit owners and not the association, because the association will in fact have the opportunity, regardless of the pandemic, to go back and try to recover the assets. So the second thing is, every court has upheld the fact that you need physical damage before business interruption. You have to have physical damage to the insured's property. And any of you who have studied or listened online or on the various news channels, the reality is the COVID-19, the coronavirus, which leads to COVID-19, has a very short life. Okay, it has anywhere from a few hours to a week. And so if you're claiming that there is direct damage, by the time you get an inspector or an adjuster out there to check it, there's not going to be any damage anymore. And I think some of the cleaning things, which I think you're going to be talking about at your next luncheon, is how well can you clean? And the problem with that is, I think that's somewhat of a placebo, because it's going to be gone by the time you really get somebody out there to clean. That's also been one of the arguments with respect to pools. If we follow the instructions of the Department of Health, we do the wipe down, we keep the social distancing, we take temperatures, all of these things, that doesn't eliminate liability. You still could be liable even if you follow everything that the governor or health department have done. So it is not going to create immunity in that case. The second thing is, does that additional work covered under your management agreement? I would say that this is extra work that you didn't previously include, and there very well is going to cost you more. And then the third thing is, are you going to trust volunteer board members to be the ones doing the monitoring? the cleaning and that type of stuff. Because a lot of associations say, well, we'll do it, we'll take care of it. And some associations, I think, probably can do that. I'm somewhat jaded because I always see the special associations out there, and I would not have them cleaning my house, let alone the pool. And there are a few other things that I think we can get into much deeper. One thing that you might want, and I'll provide it to, if I haven't already, to Mindy, is I have a 9.5-minute video that has been very successful in going into detail about all of these things, as much detail as you can go in 9.5 minutes. But that's something that some of you may want to have. Some of the management companies who are here may want to use that to provide to your associations to help them understand this. And so at the end of the day, we can go. This has caught us all by surprise. As we said, the board's duty is to preserve, protect, and enhance the association, and to avoid assuming liabilities they don't have to assume. Not everything is insurable, as we're seeing, and so if it's not insurable, the association is going to be self-insured. So if you take the risk of doing something and somebody getting COVID and you're not covered, that basically is going to be taken care of through a special assessment, unless you're flush with a lot of extra cash, which that would raise another question. And not all policies are the same and cover everything that all the different policies coverage. So at the end of the day, what you really need to do is plan. You need to determine what you can do to avoid this. You need to bring in your attorneys. You need to bring in your community association insurance professionals, and you need to come up with a plan very much like a disaster recovery plan that most, I think every association has one of those, all right? But you should come up with a plan to help you deal with the next pandemic, because the one thing that you can be sure of is the policies you currently have are going to have no applicability to this pandemic, because it's already a known factor. The second thing that you should know is any insurance that you currently have that doesn't have an exclusion, at renewal it will have that exclusion. So why don't we now go, I'll turn it over to you, Lauren, to see if we have any questions.
No, I haven't seen any additional questions come in, but now is a great time, everybody, if you have any. Might take a little bit of a delay because I'm not actually seeing the questions. So our fabulous administrators behind the scenes have chatted the one question we had come through. So we'll give it a couple of minutes. I got affected by the earthquake. I was pretty close to the epicenter, and the worst part, of course, were the 2-3 months of aftershocks. And then the windstorm knocked out my power, which of course meant no heat. It was really cold that night. You guys all remember how cold it was. And, we lit a fire in the fireplace and the kids were camping out, and it was so fun using the camping lanterns. But I was so mad by the time I went to bed when I realized that my adjustable bed was stuck in a very intense reading position all night with no power. That was the worst for me. Forget the heat, forget the electricity, forget the internet. I just wanted to lay down, and I couldn't for a very long day. So there's no insurance coverage, no replacing sleep.
I think we don't have any additional questions right now. I just want to add one thing, and especially presuming that we have a couple of community association managers listening in. One area where I think there is a possibility of good news for the managers is in the workers' comp area. In the normal course, there won't be any workers' comp coverage either, because the COVID-19 is not specific to the management companies. It basically can impact the entire population. However, I think there's a very good argument, and I know it's a good argument because the one sector that is really concerned about this is the workers' comp sector, is because management company and their employees are being required to work in a increased capacity either helping to clean, helping to monitor. And this is something that's not within the normal course that the general population is. So if by chance, and God forbid this happens, that any of the management company employees do contract COVID and there's some issues, this is something that I think you definitely need to report to your workers' comp, although a lot of people just off the top are going to probably say, no, there's no workers' comp. And as far as anything else goes, I wish some of us knew exactly when all of this is going to end. Probably the same time that we don't have any more wildfires or earthquakes. So, you know, that's all part of the privilege of being alive. So that's all I have. I don't know if you have any closing remarks.
We have a couple of questions coming in now, and one is whether you all foresee a new coverage product being released in the future vis-a-vis pandemics.
My response is no. There is in fact a product right now, and it's a product you can get through Lloyd's. I don't know about LaMond's experience, but when I bring to the association, I mean, one of the biggest things we're dealing with right now is social engineering and wire transfer fraud and ransomware, and those products to be fully insured with great limits is going to probably be about $400 to $500. I can't get an association to buy and spend $400 or $500 when the chances that one of those things happen is far greater than there being another pandemic. But you can buy it, and where it's been used, because it's in, and I don't know if Austin knows any idea of cost, but it could be, one of my brokers looked into it and he said it was hundreds of thousands of dollars, but it's usually an industry like hotels, and that really arose. I think the product was developed during the period when we were exposed to Legionnaire's disease, and that situation. And also I think there's some areas where restaurants and large chains have done this because they're, you know, like the Taco Bells or the Burger Kings, who have been exposed to large airborne or food-based contaminants. And so it exists. Whether they'll do one that would be really made for the association, you know, we got to be, one of the challenges we have to do is have to realize that unless this continues forever, it's the tail wagging the dog. And sometimes we sort of have to wait till the dust settles before we determine, and in this case, whether the dust ever settles, but that's another question.
All right. Well, UCCAI is going to post Jill's video on the website, and Mindy will mail it out or email it out to all the attendees. But I think that's it for today. Thank you, gentlemen, very much. That was very illuminating.
Let me just add one more comment, because I think people will find this helpful, is we will send to you, Austin did a fairly concise article for another chapter on the parametric insurance. And so we'll provide that to you so you guys can post that as well.
That would be awesome. Great. All right. Great job, guys. Thank you so much for your time. Have a great weekend. Be safe, everybody.
You too.
Thank you.